Today, we're tackling a crucial topic for every investor: stock market crash, how to protect your investments. Market downturns can be scary, but with the right strategies, you can minimize losses and safeguard your portfolio. We'll guide you through essential steps like diversifying your investments, holding long-term, and maintaining a balanced approach. We'll also explore strategies for navigating volatility and making smart decisions when the market is in turmoil. Stay tuned to learn how to protect your wealth during uncertain times and keep your investments on track, even in the face of a market crash. Today, we'll talk about stock market crash, how to protect your investments. So before we get started, make sure to hit that like button. Also subscribe to my channel. When the stock market crashes, it's natural to feel anxious. Your hard-earned money is tied up in investments, and the fear of losing it all can be overwhelming. However, market crashes are an inevitable part of investing, and there are steps you can take to protect your portfolio. Let's explore how to not just survive, but thrive when the market turns volatile. What causes a stock market crash? Before we get into how to protect your investments, it's important to understand what causes a stock market crash. A crash occurs when stock prices drop suddenly and significantly, usually triggered by a combination of economic factors. These can include things like poor economic data, rising interest rates, political instability, or an unexpected global event like a pandemic or natural disaster. The stock market is influenced by investor sentiment. When confidence is shaken, people panic and sell their stocks, which further drives prices down. This snowball effect can lead to steep losses in a short period of time. While crashes can be scary, they are often followed by periods of recovery, making it essential to stay level-headed and plan for the long term. Don't panic. The power of staying calm. One of the worst things you can do during a stock market crash is to panic. When you sell your investments in a panic, you're locking in your losses. It's important to remember that market downturns are typically temporary. Historically, the market has always recovered over time, and selling during a crash means you miss out on the potential gains when prices rebound. Diversify your portfolio. Diversification is one of the best ways to protect your investments from a stock market crash. When you spread your investments across different asset classes, such as stocks, bonds, real estate, and commodities, you reduce the impact of any single investment's poor performance on your overall portfolio. For example, while stocks may take a hit during a crash, bonds or gold might perform better. By holding a mix of different types of investments, you can balance out your risks and minimize potential losses. Diversification is about not putting all your eggs in one basket, and it's one of the simplest yet most effective ways to safeguard your money. Keep cash reserves. Another key strategy to protect yourself during a market crash is to maintain cash reserves. Having liquid cash available during a crash gives you flexibility. You won't need to sell your stocks at a loss to cover unexpected expenses, and you'll have the opportunity to buy undervalued stocks when prices are low. Many investors make the mistake of being fully invested in the market, leaving no cash cushion for emergencies or opportunities. Keeping some money in cash means you're ready to take advantage of buying opportunities during a crash, when stocks are typically trading at a discount. Rebalance your portfolio. As the market fluctuates, the balance of your portfolio can shift. For instance, if stocks drop significantly, the percentage of your portfolio allocated to bonds may increase. Rebalancing your portfolio during a crash is a way to bring it back to your original asset allocation and investment goals. Rebalancing involves selling some of your better-performing assets, like bonds, and buying more of the underperforming assets, like stocks, to maintain your desired mix. This can feel counterintuitive. Why buy stocks when prices are falling? But in reality, it's a proven long-term strategy. Rebalancing forces you to buy low and sell high, which is exactly what smart investors aim to do. Focus on quality investments. During a stock market crash, the companies with the strongest fundamentals tend to recover the quickest. These are companies with solid balance sheets, strong cash flows, and a history of profitability. When the market is down, it's a good opportunity to focus on quality investments that are likely to bounce back. Investing in blue-chip stocks, large, well-established companies with a track record of weathering economic downturns, is a good way to protect your portfolio. These companies tend to be more stable and less likely to go under during a crash. While smaller or riskier companies may be hit harder, blue-chip stocks often provide a buffer during volatile times. Don't try to time the market. Many investors make the mistake of trying to time the market, buying when they think it's low and selling when they think it's high. But the reality is, no one can accurately predict when the market will bottom out or when it will reach its peak. Trying to time the market can lead to missed opportunities and increased stress. Instead of attempting to time the market, focus on a long-term investment strategy. Stick to your plan, whether it's dollar-cost averaging, investing a fixed amount regularly, or holding a diversified portfolio. Historically, time in the market has proven to be more important than time in the market. By staying invested, you're more likely to benefit from the market's eventual recovery. Consider defensive stocks. In times of market uncertainty, certain sectors tend to perform better than others. Defensive stocks are those that belong to industries less affected by economic downturns, such as healthcare, utilities, and consumer staples. These are companies that provide essential products and services that people continue to buy regardless of the economy's condition. Adding defensive stocks to your portfolio can help cushion the blow of a stock market crash. These stocks may not see explosive growth during bull markets, but they provide stability when times are tough. Consider investing in industries like food, healthcare, and utilities, which tend to hold up well during recessions. Take advantage of tax loss harvesting. A stock market crash may present an opportunity to minimize your tax liability through a strategy called tax loss harvesting. This involves selling investments that have lost value to offset the gains from other investments. By doing this, you can reduce the amount of taxes you owe on capital gains. After selling a losing investment, you can reinvest the proceeds in a similar but different security to maintain your portfolio's overall strategy while still locking in the tax benefit. Tax loss harvesting is a smart way to turn a market crash into an opportunity to improve your tax situation while keeping your long-term investment strategy on track. Keep a long-term perspective. One of the most important things to remember during a stock market crash is that investing is a long-term game. Market downturns are inevitable, but they're usually temporary. Historically, the market has always recovered and continued to grow over time. Keeping a long-term perspective will help you stay calm and avoid making impulsive decisions during a crash. Instead of focusing on the short-term losses, think about where your investments will be 5, 10, or 20 years from now. Market crashes often present opportunities to buy great companies at a discount, which can lead to significant gains in the future. The key is to stay patient, keep investing, and trust the process. Stock market crashes are part of the investing journey, but they don't have to spell disaster for your portfolio. By staying calm, diversifying, keeping cash reserves, and focusing on quality investments, you can protect your wealth and even take advantage of opportunities during downturns. Remember, it's not about avoiding market crashes, it's about being prepared for them. Stick to your long-term strategy and you'll be well-positioned to come out stronger on the other side. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.